Good evening, everyone. My name is Yogesh, and I have been in Century Financial from last 8 years. I've been in this industry for a while. Uh, Welcome and thank you so much for taking our time to attend this webinar. Just to be sure, I have a lot of people here as attendees. Would really appreciate if you can just send okay if you can hear me properly, because there is always a lot of network congestion. There are a lot of um, companies using similar webinar platforms. So if you can hear me properly, just send a yes or a okay. That will give me an idea that my voice is clearly audible. Uh, Either case, if any one of you is not able to hear me or something happens to the network while we are talking, anything happens, the copy of this webinar will be uploaded on YouTube, and you can always go back and revisit what we discussed about. Before we start, on behalf of Century Financial, my team, myself, and my entire family, thank anyone who is into the healthcare or the medical industry, doctors, first responders, midwives, nurses. If you have any of your friends, your colleagues, your relatives who are working in the medical area, on behalf of my company and myself and my family, thank you so much for risking out your life for us. The pandemic has been a very hard hit for everyone, and we hope that soon this pandemic is over. And I wish all of you are in good health. So, and I wish you all stay safe. So, thank you once again. Anytime before I begin this session, I always would like to thank to all those who have been risking their lives day in, day out. I know a lot of people in my circle who are from the healthcare industry, and the pain they have to go through. The webinar will be uploaded on YouTube. It will be public. You can subscribe Century Financial YouTube channel, and you will be updated with not only the webinar video, but a lot of content which we are doing on daily basis. Now, today's webinar is a bit different from what all of you must have attended. There are a lot of webinars which happen where the experienced traders, they come, they share the stories that how they have made millions. um, Send me a text like on the chat if any one of you have attended a webinar where there have been advisors or traders who have showed you how much money they have made in 1 year, in 3 months, 4 months, 5 months. Anybody who has attended such webinars in the past, who have seen there are tricks, there are strategies which can make millions for you, which can bring so much of money in no point of time. Anyone who has attended. Okay. Okay. I'm getting different responses. Right. Some of you have attended, some of you have not. So those who have not attended, very good. Some of you have read articles like this. Some of you who have attended these, um, this is not one of that webinar. The reality behind this particular session is to make you aware about what are the risks involved in the financial markets. There are no such tricks which can make millions for you overnight. There are no such strategies where you invest and after 3 months you're making a lot of money. Yes, there are a lot of opportunities, but then opportunities come with the risk of profit and loss. So the idea is, I'm not going to show you my pictures from my different holidays, not going to show you the screenshots of my trades and how much money I have made or not. I'm not going to tell you that this is a confirmed strategy. You pay me this much money, and I'm going to make, going to teach you. What I'm going to tell you, this is completely free of cost. It's knowledge. You can gain it from anywhere. Even if you have to have a one-on-one session with me, you want to understand more about the markets, I'm readily available without charging you anything. Uh, the very idea of conducting this session is first to spread awareness about stock market doesn't mean a Ferrari and a bungalow and millions overnight. It means planning, it means strategizing, it means trying to minimize your risk and controlling your emotions. That's the reality of this business. Anybody tells you otherwise, that I have a software, I have a platform, I have a strategy which can make millions for you, it doesn't make sense. That's not how it works. If that was the case, then they wouldn't be conducting webinars and telling you that take this, buy this, pay me so I can teach you. Nobody cares about that. If they're that good, they would be just making their own money. So the first lesson is never believe on such things. It's your hard work, your involvement. And the current topic today, what we are going to discuss about is the maneuvering crisis to benefit from financial markets. Now, the very essence of the topic, it is divided into 3 to 4 parts. First, we'll discuss about different pillars of investment. Within the same pillars, we'll discuss about the importance of risk management, importance of diversification. We'll talk about how significant market history is important, how important the market history is. We'll also understand how emotions play a very important role. I have a very small poll which I have to conduct, and we'll see more and more users when they start joining. We'll see, we'll conduct a poll also just to understand that how investor psychology works, because a lot of times emotions, they get the best out of it. And in situations like stock markets or financial markets where we might see a profit, we might see a loss, we might get panicked, we might hear so many different things from so many different people that it becomes so difficult for us to take a decision. So we will cover the first thing, which will be pillars of investment, important pillars of investment. We'll talk about the current market opportunities, stocks which can do really good in 2020, and these are the sectors which we saw for a while were hit by the pandemic, but now there is a reopening, there's a reset button pressed to the economy. So all those stocks which are down, we see that what are the prospects of them recovering. So we'll discuss about that portfolio as well. And last but not the least, we'll just see how historic price movements are important for us to understand. And we'll also talk about the allocation of your portfolio. Anyone who's interested in making money, you know what you should focus on? You should focus on minimizing your loss. The first key to make profit in anything is to work on minimizing your loss. Never focus on making a profit out of any trade. Just focus on how to minimize your loss. I might sound a bit pessimistic focusing on loss rather than profit, but that has to be the reality. I have to open your eyes and understand that there's no easy way to get involved in this market. You have to steer your own ship, you have to move ahead, you have to learn, you have to read a lot, and all those things which people say that, within you work for trade for 2 hours and you can make so much of money, that doesn't work. It doesn't work like this. Anybody can lose money, anybody can make profit, but your job is to just minimize your risk. um, Again, this is also not one of those sessions where I finished my entire presentation and then you ask me questions at the end. You can ask me questions while we are talking, while we are discussing. So it becomes a bit more interactive. You have your chat mode open and you can always ask me questions. I'll try to answer as much as I can. If I'm not able to answer anything, few of my market consultants will be in touch with you and they will be able to answer you that in a later time. So starting with the presentation, guys, please understand this. Whatever I'm going to tell you today or try to teach you today, none of this is a suggestion or a recommendation or a guarantee from any type. This is a disclaimer which tells you that these whatever I'm going to tell you are established facts, market information. The portfolios which I will discuss it with you are based on the market conditions right now. Tomorrow there could be a different condition, a month could be a different condition. So whatever we will discuss, uh, keep in mind, do your own research as well, and then do your risk profiling, understand how much is your risk. Please do not take a loan, do not borrow money to invest into these kind of things. It is always riskier. Stock markets, the gains or the losses, everything is subjected to the market risk. So please be careful. I will discuss a lot of things with you. None of this should be taken as a suggestion or a recommendation or a guarantee. It's information. Take it like an information. I'm always up for more discussion later on once this session is over. Meanwhile, I'll try to answer your questions. Now, beginning with the presentation, the very we thought that the best way to make you understand where the current market opportunities lie, first you should understand about the very basis of the investing, which is the key pillars around which you should ensure that these 4 pillars uh, are with you This is like a checklist. If you have all the four pillars sorted, you are going on the right track. Profit and loss, it's a later thing, but you have started off with the right track. So make sure that the pillars which we are going to discuss, you have covered that. And if you have covered all those pillars, then the probability of you doing well in the market, obviously you get an edge over the person who has not covered these pillars. So these are few pillars which we are going to understand. And guys, this is not something which is a very exclusive content. You can find it anywhere in the Google. This is a lot of information. I have just collected everything together and tried to convey it to you together. So don't think that this is something which I have created, or this is something which you will not get anywhere. You start reading a bit, you will get a lot of information. I have just filtered it out for you. Now, beginning with the key pillars of investing, these are the few key pillars of investing. With every pillar, I'll try to throw some light on the content and the key points in that pillar. First, to begin with, the very first pillar is theory. Lot of financial advisors, you must have read in so many books, so many financial planners, so many books must have said this thing, and still the investors, they don't follow this. This is the very first rule. You measure your risk and reward. You diversify. You should have a portfolio theory. I will talk about portfolio theory also. First, talking about risk and reward. See, guys, risk and reward is something which is a very basic common sense. Today, if I'm risking $200 in a trade, which means I am ready to hold if my trade goes wrong till $200, then my reward also should not be less than $200. But what people do, and I'm sure if you had invested previously or not, or if you must have seen among your friend circle, a lot of people, what they do, they would invest. If the investment goes down, then it automatically becomes a long-term investment, because that's how the emotions get the best out of you. You tell yourself, oh, you know what, it's a long-term investment anyways. If you would have seen a short-term profit, you would have immediately booked it. But now when it's in a loss, you are just maintaining the status quo. You're keeping as it is. Even if it goes more down, you will continue to hold it. You know what this is called? This is called risk aversion, risk seeking over losses. When you already have a loss and markets are going down and you're still holding your trade, you're not letting it go, because at that point of time, letting go that trade and booking a loss can be the best thing. Because if this was a reward, if there was a smaller profit, you would have booked it immediately. But when it comes to risk, when it comes to a loss, you will keep taking it. This is called risk seeking over losses. This is a very ideal thing, that when you're losing already, you continue to hold it because you don't feel like booking a loss. You think, okay, I put $20,000, I have already have a loss of 12,000. What is the point of booking that loss? Let's hold it. It might go up. This is a very wrong attitude. You would not have waited if the to for the profit to go to 12,000, right? You would have immediately booked it. So balancing risk and reward is one of the most important things, right? If we get time in the next few minutes, we'll try to go to the live platform and try to understand that how to manage your risk, how to put a stop loss, how to so what I'll do is I'll try to show you how to balance your risk and reward. So for example, if uh, gold as a commodity, if it moves $25 a day, how many units you should do, and when you are doing those many units, what is the total account value, what is your total amount which you have invested, how much percentage profit or loss you should seek. So measuring risk and reward is one of the most important thing. Next thing, diversification. So many of you have a special expertise over some or the other area. Like for example, uh, I don't have expertise on one single thing. My mind wanders a lot, so I keep reading a lot of things. But I'm sure most of you who are here right now are focused, determined on one specific thing. That's your specialty. So sometimes this kind of thing frames into your mind that I will invest only into that particular asset class because I'm aware about it. So for example, I talk to a lot of investors and a lot of clients. They sometimes they become a bit uh, I do not want to use the word rigid, but they become more comfortable with one specific asset class. For example, a lot of people would be more comfortable with investing in Indian markets, right? but they will never be open to global markets because they're living in India, so they are familiar with the economy over there. They're familiar with the companies. But soon I will share something with you, which will surprise you. That why investing in global markets is also important, because you diversify, and not only diversify geographically. Like sometimes I ask my clients, okay, have you diversified? He said, yes, Yogesh, I've invested into Facebook, Amazon, Apple, Netflix, Google, all of them. That's not diversification. You're investing into the same sector. So you have to diversify sector wise, you have to diversify industry wise, you have to diversify economy wise. You also have to diversify asset class wise. Now, that diversification, when you uh, invest your money into different asset classes, that is called asset allocation, which also becomes a part of portfolio theory. Now, how portfolio theory works? See, it's very simple. Uh, Asset allocation must have heard a lot of time about asset allocation, but many times we always fail to understand that uh, if people are talking so much about diversification, so much about asset allocation, why there are webinars and why there are events conducted to explain this? Because it sounds very easy, you diversify into different places, but there has to be a guidance, there has to be understanding that what is my age, how should I allocate my asset classes into which asset class. Because if you have to allocate your assets, and please, if you have a notepad with you, you can keep a notepad with you, or please remember what I'm telling you, or at least go back to the recording and visit it. Best way is just to write it down if you find any point which is worth noting it down. The two primary factors of doing your asset allocation or diversification is: one, the time horizon; second, your risk tolerance. Because what is time horizon? Investment timeline. For how long you're investing your money. One is that. And then comes your risk tolerance. Now, for how long you're investing your money, it depends, one, on your age. Your risk tolerance also depends on your age. If I'm talking to a 55-year-old or a 75-year-old, let's say I'm talking to a 75-year-old. Now, the asset allocation of a 75-year-old will be very different from a 25-year-old. Because when an individual in his 20s, he can remain invested for, say, next 50 years. Imagine that, a life of 70 years. However, the life expectation has increased in so many areas. But let's say if I'm a 20-year-old, I'm not, I'm 30, but let's say many of you, anyone who's 20-year-old or 25-year-old, you'll be at least be invested into, you can be invested, remain invested for the next 30 to 50 years. That means you get enough time to absorb the market crashes, and then when the market bounces back. So the more weight can be allowed to aggressive investments such as like equities, for example, stocks, or you can invest into commodities, you can invest into real estates, those who have a higher growth potential, but they also have a higher risk. So always be careful. When I talk about higher risk, a higher reward, I also talk about higher risk. So if you're in your 20s, and or by any chance you think that you will be invested for the next 30 to 40 years in this market, your prime target or allocation should be into equities, into real estate, into commodities. Commodities are your natural resources: gold, oil, rice, wheat, sugar, coffee, anything which comes from the earth. Post retirement, like once you retire, you will not have enough time left to let your investments grow. So when I'm talking about a 20-year-old, he has that much time for the next 30 or 50 years that he can remain invested. But when we talk about a 70-year-old, now what happens to a 70-year-old? Tomorrow, let's say a 70-year-old is heavily invested into equities and commodities, which moves really wild. I'll show you the movement of S&P 500, the benchmark US index, that how it has moved between 2000 to 2009, and you take the decision. As a 75-year-old, if I see a huge market crash of 40-50%, how much time it will take for to recover? And as a 70-year-old, I have to retire. I will need that money for whatever plans I have, the cruise, or if I want to live my life happily. This was supposed to be my retirement fund. So the idea is, when you grow older, when you start getting older, you have to make sure that your asset allocation also rebalances. It changes from the riskiest assets, you go to the safest assets or less riskier assets. This is how you should keep allocating your portfolio. There are a lot of people who can assist you for that. uh, Obviously you have to be more aware, because at the end of the day it's your portfolio. But then there are a lot of services which are provided to you, and you can always take their help and plan a retirement for your end. But you always have to keep allocating, you have to keep rebalancing your portfolio on the basis of the requirement of the funds, when you need the money back, and how much is your risk tolerance. If you are not a risk taking person, then whether you're 25 or 35 or 75, it doesn't matter. If you're not a risk taking person, if you think that I cannot see a red in my portfolio, and if you're very scared, very lost, so we call such people, such investors, as loss averse. You are risk averse. You are risk averse is one thing. uh, Loss averse is very scared of taking a loss. So you have to understand your risk tolerance also. Okay. Now, when we are talking about risk tolerance, so I told you that your time horizon and your risk tolerance is very important. So when an individual is approaching the retirement age, portfolio should generally move to a more conservative asset allocation. It should focus more on bonds, more on money market funds. Basically, you are just trying to accumulate everything what you have. You don't want any more adventure in your life because you're going to retire. Now, I'll give you a couple of examples also. I'll tell you about the S&P 500's movement as well. So guys, again, if you have any questions, please keep writing on the chat. I'll try to answer while as I talk. Any one of you who is getting bored, uh, wait for it. It's going to become very interesting. Now, see, uh, before I show you the chart for S&P 500, I would show you how you do your asset allocation on the basis of age. So it's a very simple funda. Now, if those who are not noting can just click a picture of this. Anyways, if you talk to your relationship managers after that, they will be able to send you such kind of communication. Okay. Now, when you're allocating your assets, or when you are doing a diversification, or you try to allocate money into different asset classes, how you should do it for a very a very simple idea which was understood, that there was a very classic recommendation for asset allocation, and this is not from now, this has been going on for a while, that you subtract your age from 100 to find out what percentage should be allocated towards stocks or other risky assets. Okay, again, you subtract your age from 100, and then you decide that what percentage should be allocated towards these stocks or other risky assets. What has happened is, over the past few decades, a lot of things have changed for investors. Life expectancy, if you see, first of all, earlier years, in the very beginning, life expectancy were not more than 50 or 60. Now the life expectancy has actually increased. Many developed countries, it has steadily been rising. So not only individuals, they have to increase their nest eggs, but they also, I think, they have more time to grow their investments, so they cover from any dips. So earlier, if you see, back in 1920s or 30s, maybe you would live on an average 60. But now if you live on an average 75, that means it gives you that extra time to recover from the losses if you have any. So that way, what the economists, they decided that instead of, if you're a very conservative investor, you should continue with 100 minus your age. But if you become a bit moderate, or if your risk tolerance is different, now a conservative investor who is risk averse, who is not taking a higher risk, so for that particular person, 100 minus age could be the right idea. uh, Guys, I see some of you have to go for prayers. I'm sorry, there are a lot of investors, so I cannot put a pause to this. But if you miss anything, you can please go on YouTube very respectfully, and you can check. So anything if you miss, don't worry about it. We'll upload this on YouTube. Please do your prayers with no hurry, and then you can come back and again start it. So when we talk about a very conservative portfolio, we are talking about uh, a risk averse investor who does not want to take a very high chance. So let's say I am 30-year-old right now. So 100 minus 30, 70. 70% of my portfolio should be in stocks. 30% of my portfolio should be in bonds. If you are 50 years old right now, 100 minus 50, 50-year-old should be in stocks, 50-year-old should be in bonds. Bonds are relatively safer than stocks. When I say relatively safer, that means obviously there is no risk-free investment we talk about, but relatively safer than stocks, because the stock price can move really wild. I'll give you an example. Tesla. In 2 months, Tesla could have gone from 300 to 900 and come back to 400 and again back to 900, right? Bonds, however, they do not move very wild. Most of the government bonds, they give you an yield can, as of now, the central bank interest rates are all-time low. Most of the central banks are actually at a lower price, so you might see bond yields relatively low, but it gives you that kind of capital protective stand. Not that there is a guaranteed capital protection, because countries like, even if you have bought government bonds, but government, let's say Venezuelan bonds went through a default because the Venezuelan government had no money to pay back to the people. So there is no such investment as risk-free investment, but when we compare the risk, bonds are relatively safer than stocks. So if you are, say, a 30-year-old person, 70% of your allocation should be in stocks, 30% should be in bonds. Why in stocks? Because stock markets, they move also a lot on year basis, both up and down. So you're exposing yourself to a higher risk, seeking higher reward. Why you are taking an aggressive stand? Because we are considering that you will be invested for the next 30-40 years, so that is enough time for the stocks to go down and bounce back, and you can go through different cycles, right? Similarly, if you see, when you scroll down, you will see 30, 40s, 50s, 60s. So when you become 60-year-old, most of your investment switch from stocks to bonds. Why? Because now you are exposed to more fixed income yield bonds asset class rather than investing into stocks and commodities, right? Because that was a riskier part. Now you are closer to your retirement, so you would like to invest most of your portfolio, most of your money into a safer asset class. So this is how normally you do risk profiling. If you are a aggressive, if you're a risk taker, and when I say risk taker, that doesn't mean that you like to skydive. If you skydive, that doesn't mean that you're a risk taker. It tells a lot that you're an adventurous person. But when it comes to losing money, can you take a loss? And when I say can you take a loss, that means can you go aggressive and take a loss and be okay about it? Because anybody can lose money, but very few of them are relaxed and okay about it. They understand that why they lost money, because they took higher risk. They knew that they were taking that risk, and that should not affect your mental setup. It should not affect your household. It should not affect your mind. Then you become an aggressive investor. It's not that inside you feel that what is life without taking a risk. That's not what I'm talking about. So if you're an aggressive risk profile, then instead of 100 minus age, you use 120 minus age. 120 minus age means, if you, like, for example, if I am 30-year-old right now, I would invest 90% money into equities. If I am 20-year-old, I would invest 100% of my stuff into equities. Look here, the allocation is given. Even if I'm 60-year-old, you will see 60% of my portfolio is in stocks. So even as an aggressive investor during its retirement, you're at least you have a more exposure in stocks rather than bonds, because you have an aggressive risk profile. Also in the middle, you see there is a balanced or a moderate risk profile. Person who is willing to take chances, aware about the risk, and aware about the rewards. So they want to take equal chances. So as you can see that even during when you're 60, 110 minus age, you keep equal amount in your asset classes and portfolio. Anyone, guys, if you have any questions, please let me know. I'm just reminding all of you, if you have any questions, please let me know. So this is how you allocate your assets. So you put, and when I say stocks and bonds, so stocks, you put a percentage, you can put into commodities. Basically, stocks and other riskier asset classes. That will include real estate also, that will include your commodities also, commodities like gold, oil, rice, wheat, sugar, all different kinds of commodities, right? So stocks, commodities, real estate, that percentage, which this 80% which you see, it can be divided into those asset classes. So that's how you allocate your money. That's how you diversify also, because diversification is really important. What happens is, see, 20s to 30s, there is a common wisdom which holds people into around 20 to 30. You can save for your retirement. You have that wisdom that I want to save for my retirement. I want to take a slight riskier stand. I'm okay with it. I have plenty of time. I can go through a few rough patches during the investment. Eventually, you're seeking a higher reward. So there are a lot of advisors who will always recommend different stock portfolios from different demographics. 40 to 50, yes, I mean, you can still continue to go heavy on stocks if you're saving for the retirement, because investment duration is still long enough to survive any turbulence. But 50 plus, there should be a blend. 60% stocks, 40% bonds should do the trick. More than that, when you're going 70, uh, reverse. Most of your portfolio should be into bonds and less into stocks. So that's how basically you provide a risk profile for yourself. Again, these kind of rules, they can only do an attempt to define your asset allocation looking at your age. It is also important, please, I'm saying again and again, that your financial situation, when do you need this money back, it can be equally important. If you need this money within next 2 3 years, then you have to understand, you put money into bonds. If you need this money into next 1 year, you put money into a bond, you not put money into stocks, right? Have to, there has to be an emergency fund. You should have an emergency fund. If you don't have an emergency fund, then you should start building one right now, because emergency fund should be there for situations exactly like this. Pandemic, so many people have lost their jobs, salary cuts, and if you don't have an emergency fund, you know what you're missing right now. Also, you have to distinguish between the ability and willingness to take risk. You have the ability to take risk, maybe you have the money to take the risk, but are you willing to take that risk? If you do not have the willingness and you still have the ability, you have the money, it doesn't matter. On the other hand, if you have the willingness to take risk, but if you don't have enough money, it doesn't matter. You have to properly allocate money to different asset classes, right? Uh, okay, I'm getting different questions. Are you finding during this time uncertainty people are investing conservatives as a whole? So somebody asked me the question that at this point of time where people are investing, because these are uncertain times, truly understood. So I will discuss it with you, the current market situation. So the current market situation or the current market opportunities, which is the next section, I will discuss it with you, and there you can see that which are the industry areas which have started reopening, where investors have started putting some money into. So we'll take a careful analysis of that. Another question regarding specifically to the Century Financial platform. Okay, we'll try to go to the platform also once I finish this presentation, and please be with me. Commissions and fee structure of US market. Please talk to your relationship managers. They will send you a proper schedule of charges, how much it is charged, and then you can take your decision. Most of the listed companies, you're asking about, all listed companies are accessible through Century Financial. So the platform which you're using, CMC Markets platform, most of the listed companies, they're available. Not only in US, UK, Germany, France, Hong Kong, UK, most of the companies. Only in Indian stocks, because RBI does not allow the trading of derivatives. So in Indian stocks are not available. The ones which are available through US market, like the ADRs, Infosys, Reliance, Tata, Wipro, HDFC, ICICI, the companies which are also listed in US stock exchange, those are available and you can always trade in those. Apart from that, most of the companies which are listed are available. I have one more question. Based on the old sessions, you're following technology sector, Dropbox like technology, and also recovery stocks like extended stays and Southwest. Out of all these, only Southwest went up, but the others went down. Should I still hold on to these stocks or drop them? So we'll have one-on-one conversation about this, and I will explain you what has been happening with the market, and then we can decide. Brilliant. So I'm getting more and more questions, and I'll be able to answer these as well once the section arrives. Now we have understood how to allocate the assets. Okay. Now, once we have understood how to do a stock asset allocation, you move on to the next bit. So this was your first pillar, which tells you about understand, do your risk profiling, look at your age, and then plan how you want to invest. What portion should be invested into stock equities? What portion should be invested into uh, relatively safer assets? Pillar two, understanding short-term and long-term behavior of financial assets. This is your pillar two, which involves understanding short-term and long-term behavior of financial assets, understanding investor euphoria and depression, modern styles of investing and its risk. Very important. This is the second pillar, which makes you understand. See, guys, for example, every new technology which comes. So when I have written about modern styles of investing and its risk, so when I say styles of investing, it also includes the modern technology which comes. The One of the biggest market crashes which has happened was also called dot-com bubble, which happened after the internet came. So internet was a new technology to which everybody thought markets are going up, and boom, markets came down. The bubble which burst, the dot-com bubble, what we call it, where the tech started falling completely, it it came after internet was introduced, right? So introducing a new technology, like for example, maybe I think in 1929 when automobiles were introduced, even after that there was a big market crash. So a new technology can lead to a big change in stock markets. Why pillar 2 is called history? Because you should know history of the previous market crashes, the previous movement. You should know that how a particular asset class has moved in the previous history. Please remember this, note it down anywhere, and remember this, never forget. Historical worst is not the real worst you see. Today, if you go back and see, oh, last few years, last 3 years, it has gone down by this much. That doesn't mean that that's the worst it can go. Go back during depression era like 1929, go to the recession when it hit 1987 when markets crashed, 2002 when market crashed, 2008 when market crashed. Look at the historic and then decide. See, this is your investment. Like for example, if you're a physicist, if you're a chemist, if you're a pharmacist, not knowing the history where the medicine came from, it may not make you suffer that much because you know the technique, you know your product, right? Not knowing where it came from or who invented it, it may not affect you. But knowing history over here, that why the stock market crash happened, what was the reason behind it, what the investors were going through, why everybody in 2008 was just buying stocks. Nobody thought about that there's a big price asset bubble, and when it burst, the recession stretched not only to US but different parts of the world. So why the all of the investors collectively were so long in equities? What happened? We will discuss about this as well. So history is something which is really important. You should always look at the past historic data of how the asset class has performed, which gives you at least an anchor price that okay, it has gone worse this much. Okay, so I have to be ready for this much. I should have enough funds to support, or I wait for this time when it comes down, I'll buy it. You need to be very careful, and I'll show you a demonstration on the live platform that how historical prices can help us to understand, or at least uh, try to understand what will be the future expectation. Look at this. I'm showing you. I told you while we were discussing the first pillar that I'll show you the S&P 500 return. See, this is S&P's movement from year 2000 to 2007. Okay. Now, from 2000 to 2007, if you see S&P 500, this is 2001, and the gray areas are the where the recession happened. All right. So when you talk about S&P 500 movement, you will see that during these times, and these are the most important times, uh, specifically if you see month wise, the month is not mentioned here, but if you see from March 24th 2000 to 2002, from March to October, March 2000 to October 2002, almost for 2 years, S&P came down by almost 49%, almost 50%. From 2007 to 2009, October 2007 to March 2009, it came down by 56%. Right? Now, just understand this. Taking reference from the previous pillar which we were discussing, imagine if somebody had invested 80% of their portfolio allocation into stocks and he's 70-year-old. From 2000, this 2000 to 2002, 50% decline happened, right? It creates so much panic among an investor who's 75-year-old who has a 80% exposure in equities. He was doing so well because market before 2002, 2000, it was up, and now it has come down by 55, 56, 60%. So that's why your asset allocation is important. And also now you know that how S&P can go down when a market crash happens. Study the previous crashes, the dot-com bubble, the housing crisis bubble, right? You have to understand that what is S&P capable of. Right now, I talk to so many investors and they say, okay, Yogesh, it can come down to an extent. It's not going to go down by 50% in a day. And I tell them, sir, it can. Go turn the pages. I'll, so let's talk about what happened in financial crisis of 2008. Why everybody was on the buying mode in 2008? There's a reason behind it. Because some Congress, they passed a bill in 1990 in US. They said that uh, we have to make American dream a reality for everyone. Something which I remember George Bush, he made a whole agenda out of it, which is called the ownership dream, which was related to that every American should who dreams of having a house should have it. So the idea behind this was that the lenders, they should be more flexible in providing credit to even those people who are not prime, who are subprime people. Subprime, why it's called the subprime crisis? Because the people who did not have a fixed income, or who always never had a fixed job, or they were not always on time to pay their installments, they were called subprime. While the prime people, they had a fixed job, they had a fixed salary, they have a good credit score. So the idea behind this bill was that every person should have, who dreams of having a house, should have a house. So the lenders, they started being more flexible. They started giving credit to anyone, those who have jobs, those who do not have jobs. Normally, how would you buy a house? You buy a house, you pay a 20% down payment, rest is mortgage, right? But to subprime people, they would give houses, they would give loans 100% on the value, not even an installment. 100%. uh, Guys, can you still hear what I was telling you about? That why the subprime crisis happened was for the very same reason that George Bush said that, okay, this is an American dream to get a house, and the lender should be more flexible to provide credit to everyone who needs a house. Earlier, normally you would buy a house, you pay a 20% down payment, and rest you get mortgage. But for subprime people, even 100% loan was available, or as per the value of the house. They do not have to pay a single installment. And in the past, nobody even thought about that housing prices all over the United States will fall at the same time, because United States have a lot of states: California, Florida, Ohio, Pennsylvania, Kentucky. How properties in all the states together fall down? Why it happened? Because collectively, those people who took loans, later on, what started happening? They started defaulting on their payments, because they were subprime people. Either way, it was a subprime client base. They started defaulting on their loans. Now, one way to solve this was that they defaulted on their installments. The borrower can take the property and sell it at a higher price, because housing prices were up. So you still save yourself, because nobody thought that housing prices can come down. That's where they were wrong. Because when at the time when people started defaulting, at the same time, the prices, the housing, all the housing prices across the US, the value started coming down. So if you are defaulting on your installment and your asset is not even half worth of what you purchased it for, then what the borrower will do? There is no market to sell it, because nobody has the money. And that's how the recession started. Why this happened? Because nobody ever thought that across all states of US, the prices of all the properties in US will start falling. That's what house bubble was. If they have gone back to 1929, they would have understood that this is possible, because that happened in 1929. Okay, so simple. They did not look at the history, and that's how the crisis happened. Somebody asked me, if I'm new to the investment market and my excess expenditure is 6,000 dirhams per month, 30-year-old, what kind of portfolio should I have? We'll discuss about this once we are into the discussion. So to give you a brief idea, uh, any investment you do, first tell me, when do you need the money back? Is it your retirement fund, or you need this money back after 1 year, or after 6 months, or after a month? Because that is important for us to understand. If it is, again, a long term, if you're saving it for your retirement, then you can start buying some shares which are lower at this point of time right now. And there's a plenty of time that the stocks can go up, and your portfolio can gain. But again, the duration of this particular time matters a lot, right? So now we understood why history is so important, right? You have to go back and see whether it has happened or not. Everybody was under an impression that housing prices across US can never fall down, and it did. So the history always repeats itself. It can happen. You have to be more open, and you have to always take care of this. Now, moving on, We understood pillar two. Pillar three, one of the important pillars, involvement. Involvement is needed. Involvement is always needed. Because why? You have to steer your own ship. You have to be aware about what is happening around the world. You have to be updated. You have to calculate your cost. Cannot just keep buying all the time and keep booking your profits without seeing how much you are being charged. Whether it's a broker, whether it's an asset, a lot of people invest into mutual funds. When they see the returns, after the returns, there is a exit load, entry load, capital gain tax, so many things. So you have to calculate your cost and you have to be involved. You have sweat, worked for this money. Why do you think a fund manager is capable of understanding that how hard you have worked to make this? He cannot. It's not his money. It's your money. You have to steer the ship. You have to be involved. You have to call. You have to ask. You have to see where your money is going. That is important. If you think people tell you, no, you give me the money, I'll manage it for you. Why? It's your money. You have to manage it. Uh, okay, somebody just asked me about I want some long term, some short term, and some every so often, half a year. So this is something which we can always sit and discuss. I'll show you on the platform how the portfolio works out, and then you can decide for yourself. I'm about to share a portfolio with all of you, which will be the next segment, and then again you can decide on the basis of how down it is and what is the expectation in the future, right? So you have to be involved. Now there is a fourth pillar. Fourth pillar is a subject on its own, so I would discuss this by the end of this session, and we'll take a very interesting poll and see how the emotions work, because pillar 4 is related to the rationality of investor's decision. Why investors panic? What are these different behaviors which you show when markets are up, when it's down? So that is something which we'll discuss by the end of this session. Now, moving on to the next point, understanding opportunities. Now, this is something which many of you must be waiting. I suggest those who have joined, do not leave. Just stay there for this session. It should be worth the time you're giving. You can see this anytime you want, but I suggest that if you have any questions, you can ask. I can answer live, and then obviously we can connect later on. We can talk a lot about this. Now, understanding opportunities. Understanding opportunities, first, see, every crisis comes with opportunity also, because when crisis happens, stock markets come down, and stock markets comes down and the crisis is over, there will be a time when the stock starts recovering. So every crisis will have the opportunity. You have to be careful, you have to be patient, you have to analyze your risk, understand your financial situation, and then take a decision. So we are going to talk about uh, top stocks to watch in 2020. A few of you have attended my previous session, so you have been tracking the stocks. We will discuss about the tech sector also. Some of you started buying stocks like Southwest, Slack Technologies, Dropbox. So we'll talk about what's going on. We'll also talk about few more sectors which are related. Last time I talked a lot about US related companies. Today, I will talk about US and Europe both. So those who are new can just once again go through this portfolio, and we'll talk about both US and European based stocks. I'll begin with what is happening right now. Earlier, it was the lockdown trend. Now it has started becoming a step out of the house, which is gaining momentum, right? If you see throughout March and April, so which were the stocks which did really well in March and April? All of you must have been zooming, right? There is a term for it. We talk about Zoom all the time. So many of you have used Zoom, work from home tools, e-commerce related websites. Everybody ordered a lot. Amazon, these kind of companies did really well. Pharma and healthcare sector on the speculation of when the coronavirus vaccine is going to come, how who is going through trial. So the healthcare sector also was focused a lot. So we saw that stocks like Zoom, stocks like Netflix, everybody's at home, Netflixing and chilling. Companies like Amazon, companies like different healthcare related companies, computing software companies, PayPal, these kind of companies, after the January 2020, they have almost seen 30% increase, and this was during pandemic, right? During March and April. Over the latter half of the year, investors may want to switch from the work from home trade and instead look for stocks to participate in a completely different trend, which is now step out of the house, right? So we discussed about few tech stocks last time. We talked about Slack technology. Somebody was saying that they have invested into Slack technologies. They've invested into or other remote communication softwares, invested into airlines such as Southwest. So this is a living example. See, earlier the trend was mostly about remote communication. So we saw Zoom stocks going way higher. We saw Slack technologies also recovering. The tech stocks are very futuristic because now you know the technology, right? Work from home is not over yet. Yes, the world is reopening, but a lot of times historically we have seen that when such kind of things happen, there is always a phase two which comes. Now we all hope that the lockdown phase two never comes, but this lockdown has created a change among all of us. Earlier I would not know about Zoom. That technology would not be with me, but now when I know about working from home, it has created another option that if I'm not in the office, I can work from home easily. I can do a meeting, I can communicate. So the stocks which you have bought, these are futuristic stocks. Slack technologies, somebody asked me who invested into Slack technologies, invested into companies like extended stays, Dropbox. So Dropbox and Slack are very futuristic stocks. Dropbox, as we discussed last time also, it has its own cloud computing platform. So we are talking about, again, a long-term perspective where over the coming time, even when the pandemic is over, Dropbox as a company is still undervalued, has a lot of potential, right? Recovery stocks like extended stays, which is related to hotel and resorts, again, it will take time for people to go back and start living the same life, but the economy is reopening again. So just have to be patient enough, don't have to take any higher risk, and then see your portfolio how it goes, right? Now, so as I said, that this is a new trend, which is step out of the house. Now, which are these stocks which we are looking at this particular trend? We are looking at now, first about US. We discussed a lot about these stocks last time also, but many of you are new. So not only I will share about US, I will also talk about few European stocks as well. So let's start with the European first. I've discussed about US before, but this is again an updated portfolio for Europe reopening stocks as well, and that is something again which can really help out. So when we talk about reopening stocks, and now we are talking about Europe, so let's see which are the companies which looks promising. Again, these are sectors which were actually battered and beaten down by the very same fact that COVID hit. And now, when it is reopening, so what we'll do is first we'll try to understand what is the statistics behind this. Which are these industries? We are looking at different industries, guys. We are looking at industries which are related to luxury retail. We are looking at the strategies which are stocks which are related to luxury retail, hotels and resorts, aerospace and defense, again, advertising, airlines. These are few sectors which were stopped, which were down a lot. And same in US also, we'll see these kind of companies. Looking at Kering, for example. Now, Kering is a luxury retail stock. Post-COVID, the price was 357 after the coronavirus hit. Then the current market price is around 487. Pre-COVID high was 610. Now you can also see the Bloomberg analyst recommendation. So let's say if there were 31 analysts together, 19 of them have suggested a buy, 3 of them have suggested a sell, which means they don't think that the stock will go up. The ones who have given sell, the ones who have given buy, they think that the stock will go up. 9 of them have said hold, which means not into the either category. Then there is Accor, which is hotel and resorts, talking about post-COVID low 20, current market price is 25, pre-COVID high was 41, right? So we have to understand that a lot of these stocks are available at a discount. Concept behind this portfolio is that since the world is reopening, US and Europe both, there's a possibility. If you see alone in US, 2 weeks ago, where the footfall, or 3 weeks ago, the footfall on the airport was not more than 90,000, actually increased in last 2 weeks, which is around 400,000 at the airports and the check-in counters. So the world is reopening. Sooner or later, when the air travel starts, international travel starts, a lot of these stocks which were down might recover. So your bet should be only first thing that these companies might recover. When they recover and come back to their original levels, that's where you take advantage of the current discount which you have got, right? Now we'll talk a bit about all these stocks. So let's talk about, for example, Kering. When Kering is a luxury retail brand, now the coronavirus pandemic, it took a toll on luxury sector. But if you see historically, those who are buying luxury, they never stop buying because they can afford that luxury. So earlier, if they were buying five of them, they will rather buy two of them, right? Because luxury is not, the person who is buying luxury is not dependent on salary cuts. Yeah, I mean, less people will come out of the house. So earlier, if five were being purchased, two of them are purchased, right? Now, what we have seen is, again, there were a lot of Chinese luxury brands which were available at a discount, and it has been a kind of revenge taken from China, that since a lot of luxury brands have come down, most of the people are buying. So Chinese consumers themselves, they are like positioned for a recovery. So there's a possibility that the worst may have passed for this particular company. It is one of the most like biggest and profitable brand. Gucci is in this. Gucci accounts for 60% of sales, and it has outsized exposure to Asia. So this is something, again, which you can put. And Kering also owns brands like Balenciaga, McQueen, Brioni. This is something which is, again, I'm not only looking at the company for what brand it has. Look what kind of cost they have saved during the COVID. They have cut down dividend cuts. So there are they have cut down dividends, not dividend cuts. They have cut down the dividends by 30%. Cutting down your dividends by 30%, good thing. That is something which goes into the balance sheet right away, right? When you cut down your dividends. Those projects which were not very essential, those projects have been postponed by Kering, right? And if there were any advertising campaigns not happening, so that cost is also saved. Other projects are not happening, cost is saved. There have been obviously salary cuts, management cuts, rents have been renegotiated. Even over here in Dubai, you will feel that the rents have been negotiated, right? Renegotiated. So this kind of cost, when cut, the balance sheet looks pretty promising, right? So again, when the world reopens, the very first thing is this balance sheet is pretty much balanced because a lot of expenses have been cut or stopped due to the pandemic. So that should be easy on the balance sheet. China, for example, again, if you see about mainland China, it's a very big positive point. Whatever has been the weakness in the second quarter, once the world reopens, that kind of losses can be offset. So this is one company which is, again, expected to perform better. And this is, again, European-based companies. We have not discussed this before, discussing for the first time here on the webinar as well. Second, looking at Accor. Now, Accor related to hotel and resort. We talked about extended stay last time, which was again a hotel and resort company. The key point about extended stay was it is a budgeted hotel, and even during the pandemic, that hotel did not shut down because most of the government employees and medical doctors were staying in that hotel. So a kind of edge which the budgeted hotels have over company like hotels like Hilton during the pandemic time. So that's why Hilton during pandemic was not very promising, but extended stay even after that was promising. We discussed about Hilton also. Now the world is reopening, so we'll talk about Hilton as well. So first, in hotel and resorts in Europe, we are talking about Accor. Accor is again a company which you can focus on. See, there was a lot of travel restriction, and there was a devastating effect which happened on hospitality business. Accor is one of the largest hospitality company in Europe. Their revenue also fell almost around 17%. Even after this setback, they have still managed to open 58 hotels, around 8,000 rooms in the market. Their economic conditions are very difficult right now for this particular industry. But even during this condition, if they have managed to open 58 hotels and more rooms, it's a good thing. It's a very significant achievement. Okay. If you see their booking platforms also, before COVID, before this pandemic happened, their booking platforms of the firm, almost per day around $1.6 million worth bookings happened. This was before pandemic. After pandemic hit, it was just $100,000, which was obviously less. But now this has started going to 500,000 again. It is still very far from what happened in 2019. Occupancy, again, when we talk about the speed of recovery, it is very impressive. Not 2019 levels, but the recovery is very impressive. People in China have begun to reopen again. So that's why we are expecting that maybe the upscale properties might improve a bit. And those who do not know about Accor, Sofitel, Ibis, these kind of hotels comes under Accor. So it is a very big company. It is one of the most important and a very big name in the hotel industry, right? Somebody has asked me considerations about the crypto market. I'll talk a bit about crypto market. Not much what we really favor in terms of cryptocurrencies, but I'll discuss about cryptos as well. A very good question. Uh, Another stock which we have on European is Airbus. So if you can see the post-COVID price of the post-COVID low, after the COVID happened, the low was 49 euros. Then the current price is 66. It is already up from the COVID low, by the way. And we have been pitching this portfolio for a while now. So we are looking at the current market price, 66 euros. Pre-COVID price is 139. Now this is interesting. You're still looking at a 50% discount, and it's industry. We're talking about Airbus, right? Similar to what we saw in Boeing, the travel was completely restricted. So we saw a fall in price of Boeing also. We saw a fall in price in Airbus also. When we talk about, and this is a European company, this has rallied already 30% from its post-COVID low. Okay, and now when economies are reopening, this particular discount, uh, there is a market discount. It can actually pent up the travel demand. And once the demand for air travel, it comes closer to the pre-pandemic levels, the airlines like different Lufthansa or other airlines also, they will be looking to buy new aircrafts, and majority of their fleet uh, is under warranty, right? And it is not as susceptible to breaking down. The very simple thing is, if after so long, when airlines are opening once again, the planes have not worked for almost what, 2 months now or 3 months, even now the air travel is not. Do you really think it will be easy for the customers to get back and sit in the old planes? It is not very convincing. It's a very simple thing. It's passenger sentiment. I mean, if you look about, for example, let's say if after 3 months the airlines have started again, obviously there are millions of people who will not want to fly with outdated planes if they are paying a high price, right? So that is again something which is you have to see. Why Airbus could be a decent buy? Because once the demand for the, like, if the people start traveling again, millions of people, you cannot convince them to just go back to the planes which have not been used in last 2 or 3 months, right? So Airbus and Boeing, these kind of companies, they can again recover from these lows. So this is something which you can again keep a check. Then we discussed about Rolls-Royce last time. Something which we did not discuss about was WPP. Again, this is belonging to the advertising area. Even the advertising industry has taken a lot of stress, and it is like, when you talk about WPP Group, it is the world's largest advertising company. It owns agencies like Wunderman Thompson, Group M. They have like amazing blue chip client base, and definitely it's a value addition to your stock, because this stock is almost down by 40% year till date. Year till date means January till now. The stock is almost down by 40%. The client base is very diverse, and even like when, like, during the crisis, a lot of them were performing really poorly. Some of them are doing really better. So that diversification of the client, uh, the in the COVID also, few sectors were doing really good, few were doing really bad. So if I am advertising agency, I also have clients who are doing really good, who are doing really bad. So there is a diversification, right? You are somewhere in between. So this kind of thing prevents you from having an existential cash crisis, like a retailer or a car rental company, right? They might be experiencing a cash crisis. But when you're talking about an advertising agency, their portfolio is quite diverse. They're belonging to different industry. Retail and travel exposure is about, like, if you see the client base, only 10% of the client base is related to retail and travel exposure. Most of them are large tech, and they have like CPG exposure. It should provide a very solid base to the company, right? Company is doing fine. Obviously, they have suspended their dividends. There are no stock buybacks. Also, it is saving around 1.1 billion dollars to this company. So when we are talking about a company which has over $4 billion in cash and most of other liquidity options available, it is something which is good. Their client base is good, diverse. Only 10% of their client base is divided into travel and tourism. So that is something which is good news. So this company again is we are looking at the advertising sector. Again, guys, whatever I'm telling you, do your risk profiling and understand. Read more about all of this. Talk to your relationship managers; they will send you the entire portfolio, right? Going before this, before I step on to the last pillar, we have discussed about in the past about US stocks. Again, guys, as I said, once this webinar ends, you can go back to your relationship managers, ask them for this reopening stocks portfolio, and they will send it to you. We talked about stocks like Carnival Corp, Las Vegas Sands. Las Vegas Sands is a gaming company and gaming company and casino. And what we understood was most of their revenue, 85% of it, comes from the operations which are in Macau and Singapore, which is Asia. And to be fair, the Asia territory is very adaptive to such pandemics. It's not something which is, a big deal. So if your major exposure is in Asia and the world is reopening, so you will probably see people being more, going out. If you have been to Macau, I've been to Macau just once, and I've seen like people are crazy about, gambling over there. So this was again one company which was available at a decent discount, and we suggested Lyft, for example. Lyft, if you've heard about Uber, you would know what Lyft is. In US, by the way, if you take a survey, Lyft has a much more proper user interface and much innovative services and a great service as compared to Uber. So Lyft is also something, after the lockdown opens, obviously, not everybody would use a public transport. They will still refrain from using a public transport because you don't want to get into a confined place with other person. You have to practice social distancing. Social distancing is the truth. It's going to be there for a while. So again, stocks like Lyft can be something really good. We also talked about Hilton. We talked about Darden Restaurant. Darden Restaurant is one of the biggest restaurants, and restaurant industry has also taken a hit. If you see, right now, I live in Bur Dubai. I went to Khalid Center for some work today, and the McDonald's in Khalid Center is gone. So a lot of restaurants have taken a hit. Darden Restaurants is one of the most giant, restaurant chains, and this is something good because the smaller restaurants have been shut down. This kind of increases the market share for there are other stocks like Delta Airlines, Hilton Worldwide. We talked about Southwest also being the domestic airliner. International travel is still banned, but domestic airlines is still going on. Could be something which can be really good. So you can look at all these companies, and this portfolio can be sent it to you. Now, uh, going next, I told you that there is one more pillar which we had to talk about, and that was psychology. And psychology is one of the most important pillars, which also defines something what we call as investor behavior. Okay. Uh, as I told you about the stock market crash, why the stock market crash? It happened for a very simple reason. And now I'm about to take that poll which I talked about. Let's before I say anything about psychology, I'm just going to put a small poll, and I just want to hear your answers. First, I will read the question for you. Okay, just answer it when I publish the poll. First, hear my question very clearly. Imagine you have decided to see a play where the admission fee is 60 dirhams per ticket. Now, when you enter the theater, you discover that you have lost 60 dirhams. You have enough money in your wallet to purchase the ticket. Would you still pay 60 dirhams for a ticket to the play? Now, again, I'm repeating the question. You wanted to see a play for 60 dirhams. So you entered into the theater. You did not purchase the ticket yet. You never had the ticket with you. You had 60 dirhams and you wanted to purchase the ticket, but somehow you lost 60 dirhams. You had more money to purchase the ticket. But now the question is, would you still go ahead and purchase the ticket, right? You have not purchased it yet. You had the money for it, but you lost 60 dirhams. You have more money. You can still purchase it, but would you purchase it or not? So I'm going to publish this poll, read the question once again, and answer. You can see the poll right now in your screens. You have more money to buy the ticket. You can still purchase the ticket, but the point is, would you go ahead and purchase it? Yeah, I'm just waiting for this question to get over. Okay, guys, please vote for this. Please vote for this. All of you who are present here, just vote for this. This is something which will tell you a lot about investor psychology also, and will make you understand that why understanding investor behavior is really important, because emotions always get the best out of us. Okay, I see votes here. Okay, anybody else? Please vote. I'm still getting a lot of votes here. I will end this poll and let me know if you could see the results. Anybody else who has not voted, please vote if you have not voted yet. Okay, I'm going to end this poll and I'm going to give you another question. Okay, I'm ending this poll. Okay, can you see the results? Anybody can see the results? Yes or no? Just give me a yes or no. Otherwise, I'll tell you what the results are. Anybody can see the results now? Yeah, 50-50, right? So all of you, half of you said that you will purchase it. If you have lost 60 dirhams, you will still go ahead and purchase it. Half of you said no. Now I'll give you one more question, very much related to this thing. Okay, just remember this. Resetting the poll, adding a new one. Now my question is slightly different, but on the same lines. Now the question is very simple. What we talked about. This. Okay. Now this is the another poll. You remember what you did in the last. Now tell me about this one also. Now, I'll read the question first and I'll publish the poll again. Imagine you have decided to see a play and paid the admission price of 60 dirhams. This time you have paid 60 dirhams ticket. Now, when you enter the theater, you discover that you have lost your ticket. Would you pay 60 dirhams for another ticket? In the last poll, you never bought the ticket. You had the money, but you lost that. And then some of you said, yes, we will go ahead and purchase the ticket and watch it. Now, this time you had the ticket, but you lost the ticket. Now you still have the money to buy the ticket. Okay, would you purchase the ticket again? Again, guys, there is no right and wrong. It is about your mindset. It is about your understanding. That's all. There is no right and wrong question in this. Just put a yes or no. I just wish to see different results. Some of you must be contemplating. Okay, so I hope by now everybody has voted. I'm going to end this poll. Okay. Now, can you see the results which I've put? 57% of you said yes, 42% said no. This was 60-40 also, by the way. Now, when you saw the first option, half of you said, 50% of you said yes, 50% of you said no. That if you had, in both the cases, by the way, question 1 and question 2, both the cases, you are 60 dirhams less now. Because when I asked you the first question that you wanted to purchase a ticket, but you lost 60 dirhams, would you pay another 60 dirhams and buy the ticket? So you lose that 60 dirhams and then now you pay 60 dirhams and take the ticket. In this, you had a ticket which was worth 60 dirhams, which got lost. The only thing how psychology plays the role is in the first thing you said, 50% of you said yes, no. The people who said yes, what they are thinking humans, they have budget for everything. They always have a budget. My entertainment budget, my food budget, my taxi budget, my accounting, every different budgets. So if I've lost 60 dirhams, before purchasing the ticket, I will think, okay, uh, this maybe the 60 dirhams which I lost, it was not my entertainment budget. I can still buy and keep it, right? The money was not allotted to the entertainment budget. But second question which I asked, the money was allotted to the entertainment budget. Right now, the polling which has come across where 50% of you said yes. If you have lost the ticket of 60 dirhams, you will buy another ticket and watch it. 47%. This is a very close call for both the things. When this survey I did in my office with more people in it, most of them said if they have lost 60 dirhams, they will take 60 dirhams and buy a ticket. But if somebody has lost ticket worth 60 dirhams, they were not ready to pay another 60 to buy the ticket, because now you're basically watching that play for 120 dirhams, which is exceeding your entertainment budget, right? In both the cases, you are losing 60 dirhams. It is insane. In both the cases, you are losing 60 dirhams. You are 60 dirhams less. The only point is this is how the psychology plays its role. When you see the markets, when you see different movements in the markets, this is something which is called mental accounting. Now, why mental accounting plays an important role? Because see, it is very simple thing. This is where sometimes what happens is, yeah, somebody said maybe it's just a disappointment of losing the real value, which is the ticket. It can be. So as I said, there are no right and wrong answers in this. It is just about how your brain works, right? That's why psychology is really important. See, like for example, when you go and buy a car, if it's a 100,000 dirhams car, you don't mind adding leather seats, cushion covers, or whatever it is, which is worth 3,000, right? Because you're spending 100,000. If you have bought a $300,000 worth house, you don't mind spending a bit on the furniture, maybe let's say 10,000, because you bought a 300,000. But that is also, imagine this, when you bought a $300,000 worth house, at the same time, $10,000 worth furniture, you went and got it. It did not hurt it. But let's say you bought $300,000 worth house. Listen to this very clearly. You bought a $300,000 worth house today. After 3 months, you spend $10,000 on furniture. What hurts you the most? You buy a $300,000 house, and on the very next day, you go and buy the furniture for it, and now your house is a thing. With 300,000 you already spent, 10,000 you spend more. May not hurt too much. But you spend $300,000 today on the house. After 3 months, you went to the furniture shop, spent $10,000 there. That will hurt you the most. This is called mental accounting. This is a bias which investors have. Why? Now, how it is linked to your investment? It's very simple. When you put $20,000, let's say in your trading account, right? And if you made a $500 profit, you will not and you will not book that profit. Why? Because this is $500 over 20,000. Or if it is a $1,000, you do not book the profit because this is $1,000 over 20,000. You wait for it. What happens? Market comes down, your portfolio gets screwed. A lot of people, they lose money because they don't book the profits, right? Now imagine if you remove this mental accounting bias, and from a different reference point, imagine that I am making $1,000 profit. Take that, take that $1,000, something which you did not have. Imagine right now you do not have $1,000. 2 seconds, close your eyes, open. Imagine now you have $1,000. How do you feel? This is called mental accounting bias. You have to separate your profit. Don't look at a point that, oh, on $20,000 you did not make $1,000 profit. On $20,000 you made a 5% return. See it that way. See this money as the money which is separate. Don't compare it with $20,000. That's the point why people do not book quick profits, and when it is going loss. So sometimes what happens, $500 profit is there. There are different things. Sometimes there will be people who will quickly book the profit, and they will wait till the loss happens. They will keep accumulating the losses. That's a different bias. That is something which we call risk seeking over losses, or that is something called a belief bias. But right now what I'm talking about is they will have a certain amount of profit, they will not book it. They will not see it as a separate money. They will just keep holding on to it. So these kind of bias, they always affect your portfolio. That's why the psychology is something which is really important. overconfidence. In 2008, one thing which happened was every investor became overconfident that it is not possible that all the housing prices across US will go down. If you make money in a market which is already going up, that is not your skill, that is just luck. Don't get overconfident. That is one thing which will kill your portfolio. Poor understanding of the valuation. Sometimes people are like, a lot of people, they ask me, should I buy Apple right now? Should I buy this particular thing right now? Right now, if it is already overvalued, just because you are so much into that company, you have heard things about it, and you just want to buy it at any price. You have to wait for the right evaluation. This is called availability heuristic bias. When you get so much clouded, when your judgment gets clouded by media, people, herd mentality, that is called availability heuristic. That you see things around and you just want to buy it, so you end up buying at any cost. You don't look at whether it is undervalued or overvalued. And third, most important thing which comes under the psychology pillar, over trading. You don't have to trade every day. I am telling you, if I am a broker, I'm charging you transaction cost. Trading every day, you're just making money for me, not making any money for yourself. Because over trading is something which kills your portfolio. Sometimes there are just days when you don't have to trade, wait for it to come down. So many people have done so many over trades because they cannot help themselves. They just keep trading. They think every time there's market opportunity. It's not. Sometimes markets, like right now, market is not a bull market. It's not a bear market. It's a kangaroo market. This is a new term, by the way. Search for kangaroo market. You will find it. It's a kangaroo market. Goes down, it goes up, it goes down, goes up. Nobody's able to understand why it's crashing, why it's moving up, right? Sometimes you have to be very patient. If you understand these few factors, uh, uh, I'm just about to finish this session. So anybody, if you can wait for 5 more minutes, we'll be ending this session. I'll just quickly go to the platform and show you. But again, you can catch this on YouTube again. So don't have to go and try to overtrade too much, right? Now, quickly we'll go to the platform and we'll understand a few things. So there were a few questions. I'll just take these questions as well. Okay, somebody about Tesla, why Tesla is so high. I would like to understand to make a strategy and follow it. Uh, See, we'll talk about making strategies. Let's do it one-on-one on the session. I'll be available. Uh, okay, we'll talk about question, Dropbox, Slack. Okay, we answered that. Okay. Okay, somebody had a question specifically about the platform. What was it? So I can quickly just go to the platform and for the next 5 minutes and talk about this. Anyone who had a question specifically about the platform? Okay, I'm just sharing my screen just to give you an overview how you can do a risk management on your platform. If you any questions pop up, just let me know. Just 1 second. This is the last thing here. Okay. This is your trading platform. Okay, these are the couple of trades which I've just placed right now. But for you, important to understand is when you do a transaction, how do you manage your risk? Now, for example, I have purchased gold 100 ounces at 70.26. Okay, managing risk is very important. So we're talking about risk and reward, right? Let's take gold example and finish this. Look, the gold price is this is in dollar per ounce. Okay, dollar per ounce means okay, platform related or not. Okay, so dollar per ounce means this gold price, this is priced in USD, and 1 ounce is equal to 31 grams. Okay, now when we are looking at gold, the lowest price gold has come today 1712. This is very important. Please listen to this. Lowest price is 1712, highest price is 1730, which means gold has already moved almost around $18, 18 or $20 in a day. Now, imagine this. If you have $10,000 in your account, right? And you buy, let's say, I'm going to give you a proper understanding of this. Let's say $10,000 worth gold will be equal to 5.5 ounces. Let's take 6 ounces. 6 ounces of gold. You have seen that gold has moved $20 today. $20 means 6 ounces. You're talking about $120 profit or $120 down, considering that on an average gold moves $20 in a day. Now, if gold moves $20 a day, you have 6 ounces, which means you might end up making $120 profit, $120 loss. In a $10,000 account, If we see $120, that is almost 1.2%. 1.2% on one trade. We're talking about $120, right? Now, if that is your profit, how much you should keep a restriction on the loss? If this is what your profit expectation is, how much you should keep it for the loss, and how you can set it in this particular transaction. Let's say I open a separate trade. This is $10,000 worth gold. I click on buy. Now, apart from this 100 ounces, I have taken another 6 ounces, which for this demonstration here. Now, this is the 6 ounces which I have purchased. Now, if I have to take a risk management step, I click here, and now I can put a stop loss. So if I am aiming to make $120 profit, I should be ready to take at least a $50 of loss. So your stop loss price and your take profit price, even if you're not logged into this platform, you can modify and keep it. Stop loss 1718, take profit 1746, current price is 1726. So if gold goes to 1726, your profit will be booked. If it comes to 1718, your loss will be booked. This is called a 2:1 risk reward ratio. You are risking $50 to make a $120 profit. This is how you balance risk and reward. This can be equal, but in no point of time you should be risking $200 to make a $50 profit. This is what most of the investors do. So this is how, first step, find out how much a particular product moves. Dow Jones index moves 400, 500 points in a day. So if you buy one unit, you might end up making a $500 profit or a loss. So if you are aiming for a $200 profit, at least book your loss at 100 or 150. Do not let your losses get exceed than your profits. Right. So this is a quick risk management thing. Now, those who wanted to leave can leave. I think there is one more question left. Somebody had a question till the session ended about the copy trades. We do not do copy trading and copy trading or robo trading. That is something which is it's not a concept. Those platform providers or brokers who provide it. Uh, I told you the pillar 3. You have to be involved. If you're not involved, if you're not steering your own ship, you're relying on somebody else, it's not the right idea. Take your time. I will make you learn how this works free of cost. This is knowledge learning. This doesn't charge anything. Don't pay hundreds and thousands of dirhams, 40,000, $10,000 to learn these things. You just have to be more aware, practicing, and that's it. Don't try to get into copy trades. It's not something which you would want to get into. Anybody else? Anybody else? Any other question? Somebody had a question by the end of the session. This is the end of the session. Anybody else? Any questions? Please tell me. The copy of this portfolio, it can be sent it to you. Please talk to your relationship managers and they will send it to you after I end this session. Take demo accounts. Anybody who will be willing to take a one-on-one session with me, please let me know. Talk to your relationship managers and we can have a one-on-one session. No commitments, no cost attached to it. You want, we can have it. Any difference between the platform and others? See, the difference between this and I'll tell you one standard platform, which is MT4. This particular platform is developed by the traders. So there are a lot of features which you will see on technical perspective, something which is related to over here. Like for example, very quickly, I'll show you the breakout patterns, the emerging patterns, where you see that already under the algorithm, a technical pattern has been defined. So for those people who are not aware about the charts or channels, you could see that, see, this channel got broken and this is the expected target. So this is something you will not find all these things in MT4. This particular platform has been designed by the traders. So there's a lot of different features which we can talk about once we have a one-on-one session. Right. So, okay, somebody still wants to understand how to make a strategy and follow. So, sir, we can have, let's have a one-on-one session after this is over, maybe let's say tomorrow or day after. Let's find a time, let's sit together and make a strategy and understand more about this. Right. Once again, guys, all of you have been so patient and brilliant. All of your questions were amazing. Thank you so much for asking those questions. If you're not satisfied with anything, one important thing, please, before you go, I really rely a lot on the feedback, and that's why before you leave or after you leave, please review us on Google, whether you liked the session, you did not like the session. anything. I'm really hungry for feedback. I want to continue. We have been doing these sessions for a while now, and I want to continue more and more, spread more and more awareness about this. So if you really like the session, please go on Google right now, review us. If you have any comments, please do write about it. My name is Yogesh, and let's sit one-on-one, talk to your relationship managers, get these portfolios, and if you have any problems, we'll discuss about it. Any advice on time spending on trading daily? If you're a day trader, your key timings should be uh, when the Europe opens and the UK opens at 11 a.m. That is something which is a really important time. You can see for the next 1 hour how the market moves, because important news comes out around 12 and 12:30 p.m. afternoon for Europe and UK. That's the important time. US market opens 5:30 p.m. and that's high volatility. So you can perhaps after 5:30 market opens for the next 1 hour. So let's take, even if you give 1 hour a day and try to execute your trades, diversify and put a stop loss and take profit, actual execution or continuous monitoring could be more than 50 minutes to 1 hour. But just keeping a check on the watch list, that is something which you need to be involved. You're, let's say, walking around, quickly logged into your app, looked at your watch list. Okay, today's low is this much, highest is this much, gold price is this much. Out of sight, out of mind, as simple as that. Something which is in front of your sight, it will always be in your mind. Not necessary that you have to give your whole effort into it. You have a lot of jobs to do, a lot of people, their parents over here, they are juggling around too many things, so it's not going to take too much of your time. Specific timings: US market 5:30 p.m. important time, UK Europe 11 a.m. important time. So throughout the day, just keep a proper look. What is the low, what is the high? When I explain you the platform, you will understand that how easy it is to keep a check on the lowest of the day, highest of the day, just by putting a favorite list. That's it. Just a careful, what do you say? In Urdu, they say sarsari nigah. That's all. Just overview it, and that's all you need to do. Please, again, maintain your risk. Do not take a higher risk. Do not borrow money to do this. Any doubts you have, let's have a one-on-one session, and I'll be more than happy to assist you. So I hope all of you enjoyed the session. This was not one of those sessions where I could promise you or guarantee you returns or Ferraris or million. I might have scared you a bit about how markets work, but that's the reality. So let's stick on to it. Don't pay to anyone for any of these courses. This is something which you can learn on your own. Let's book these sessions and try to talk one-on-one. So thank you so much once again. Please reach out to your relationship managers and stay home, stay safe. More than anything, stay invested. There are a lot of opportunities right now in commodities market, also in stock markets also. Understand your risk and then discuss about it. Right. Thank you guys once again. Please review us on Google as well, and we'll be back very soon. We'll have another webinar in the coming week on a different topic. We'll talk about market neutral strategies. We'll talk about different strategies. Some of the times we will discuss about the platform also. So, but anyway, till then, I'm available for a one-on-one session. So thank you so much, guys. Stay home, stay safe, stay invested. Let's be in touch.